Hello, ladies and gentlemen. I hope you are fine, wherever you are, guys. I am the Acca tutor, Mr. Jeremy Timikulu. I welcome you all to this video where we'll be deliberating or tabulating uh, issues related to the lease versus buy decision. All right. If you still remember, in your performance management paper, we looked at uh, the make or buy decisions, where we were evaluating whether we should manufacture items in-house, or we can just buy them from outside. In this case, it's almost like a similar situation, although here we are looking at non-current assets where we have to decide whether we have to lease or just to buy the item. All right, so far we've been looking at a situation where we have to buy from outside. But now we need now to compare whether to lease the asset could be more beneficial than to buy the asset from outside. So in any case, we need to compare the PVs of either leasing cost or buying cost. But both should be discounted at the after-tax borrowing cost. Borrowing cost of capital. Sorry. We're talking of the cost of capital here. All right. So the discount rate should be the after-tax borrowing cost of capital. All right. That's what we are going to use. All right. So we need then to do the calculations for buying as usual, and then do the calculations for leasing, so that by the end of the day, we compare which costs are cheaper for the business. All right, so let's look at this example and see what happens. A company is considering whether to buy a new machine at a cost of 100,000 or alternatively to lease it for 35,000 per annum, lease payments payable at the start of each year. Buying it will involve borrowing money at an after-tax interest cost of 7% annum. If the machine is bought, it will be bought on the last day of the current financial year. The machine will be needed for 4 years, and if purchased, will have a scrap value after 4 years of 10,000. Corporation tax is 30% payable 1 year after the end of the financial year. Capital allowances are 25%, reducing balance should the machine be leased or purchased. So, as I've already indicated, we need to come up with both computations, the computation for buying and the computation for leasing. All right, so let's start with the computations for buying. All right, if we buy the asset, we are also entitled to the tax allowable depreciation, and let us determine the capital allowance computations first. All right, so capital allowance. If we buy, okay, if we buy, so we've got the information here is telling us that corporation tax payable 1 year area after the year end. All right, and the machine will be needed for 4 years. All right, and the cost of the item is 100,000. Okay, 100,000. So we come here, we say the year zero, where when we buy the asset, the cost of the asset was how much? 100,000. All right, and we are allowed depreciation of how much? 25% reducing balance. So the capital allowance is 25%. So 25% of 100,000, this is 25,000. Okay. So if we deduct from 100,000, we are left with 75,000. Okay. Then year 1, the capital allowance becomes how much? Capital allowance, that's 25% multiplied by 75%. And we should get how much? Let me use this calculator of mine. 18,750. We deduct 18,750 from 75,000, we are left with 56,250. So year 2, we have got capital allowance 25% again, multiplied by 56,250, that's 14,062. We deduct, we are left with 42,000. Okay, 42,188. So year 3, capital allowance 5%. 25% of 42,000, that's 10,547. We deduct, we are left with 31,000. Okay, 31,000, how much? 641. That's the balance we are left with. And then we continue up to year 4. Year 4, in year 4, we sell the asset and we get something. The scrap value will be there's going to be scrap value of 10,000. All right, so we're going to get 10,000. So we come here and say year 4, there is a scrap 10,000. Okay, so obviously the capital allowance is going to be 25% of the remainder, that is 21,641. Okay, so that amount is going to be claimed on the balance there. All right, so let's now talk of the tax allowable depreciation. All right, I mean the tax savings. Tax saved we buy. All right, remember the tax rate is going to guide us. The tax rate is 30%. So that's multiplied by 30%. Here multiply by 30%. Here multiply by 30%. And we are also going to multiply by 30%. All right. Also have to multiply by 30%. There. Okay. All right. Okay. One might be wondering what would be going on, because so far we are told that the machine is going to be in use for 4 years. All right, but we are having 5 tax payment periods. The issue is that the machine is going to be bought at the end of year 0. Okay, we are told the machine, if it is bought, it will be bought at the end of year 0. All right, so which means this has impacted on our tax periods. So we are going to have 5 tax periods. Okay, we are going to have 5 tax periods. All right. But we are also told that the tax is payable in arrears. Okay, 1 year in arrears. So we are going to start paying this tax. The machine will be, corporation tax is payable 1 year after the end of the financial year. All right, so we are going to pay starting from year 1. Okay, we are going to pay starting from year 1. This is not actually equivalent to the statement that says tax is going to be paid 1 year in arrears, but it actually says that the tax is going to be paid in the year of operation. That is in the year when we start producing something. So that is at the end of every year. All right, so starting from year 1. All right, that's when we are going to pay the taxes. So this means that the tax saved here, 25,000 multiplied by 30%, is going to be 7,500, which is for year 1. All right, it is going to be paid in year 1. To be received in year 1, or to be saved in year 1. And then 30% of 18,750. This should give us 5,625. Okay, this calculator of mine does not show that. Okay, and then 14,062 multiplied by 30%. We get 4,219, and then 10,547 multiplied by 30%, that gives us 3,164. And lastly, 21,641 multiplied by 30%, that gives us 6,492. All right, and this should be for year 5. All right, this one year 2, year 3, year 4. All right, now we have done the basic computation. Then let us do the NPV computation. NPV computation. If we buy, all right, so we do our NPV table. We have got year 0, 1, 2, 3, 4, 5. All right, can underline. All right, then we know that the cost of the assets was 100,000. All right, and the scrape value is going to be 10,000, but this occurs after 4 years, not in year 5. Let me just underline these columns. Forget my drawing prowess. Just forgive me there. Okay, so we then have to worry about the tax saved. Okay, and this one is found in this computation. For year 1, we saved 7,500. Year 1. All right, and then year 2, 5,625. Year 3, 4,219. Year 4, 3,164. year 5, 6,492. Alright, so we just do our additions and come to net cash flow. Obviously in year 1, in year 0, that's negative 100,000. That is the initial investment. Then here we've got 7,500 for 219 and 41. Okay, that's not 41 there. It's 10,000 plus 3,000. So it can't be 41, but 13,164 and 6492. Then discount factor at 7%. Remember, we are using the 7% discount factor because we are told cost, the after-tax interest cost was 7% per annum. The after-tax borrowing cost or the after-tax interest cost was 7%. And in both cases, we are going to use the same discount rate, whether we are computing the lease payments or the buying costs. We are going to use the after-tax cost of borrowing. All right. So in year 0, it's 1, obviously. Year 0, it's 1. Then in year 1, that's 1 over 1.07 to the power 1. That's 0.935. Then 1 over 1.07 to the power 2. That's 0.873. Okay, excuse me, it's very hot. Okay, then 1 over 1.07 to the power 3 for year 3, that's 0.816. Then 1 over 1.07 to the power 4, that's 0.763. Then 1 over 1.07 to the power 5, that's 0.713. Then we get our PVs. Obviously in year 0, it's negative 100,000. And here we get 7012 and 4911 and 4219 multiplied by 0.816, that's 3443 10 044 4629. Then we get the NPV. NPV would equal to minus 100,000 plus all these figures in the same row, and we should get how much there? Negative 69,961. So if we buy, we are going to have a negative NPV of 69,961. What about if we lease the equipment? All right, if we lease, we just do the same. Okay, if we lease, we've got here 0, 1, 2, 3, 4, 5. So we are going to be confronted at the same what's going on. Okay. All right, so we need to revisit our question again and understand how the lease payments were paid. All right, in this case, we are told that the lease payments are payable at the start of each year. So the 35,000 lease payments are going to be paid at the beginning of the year. So we're going to start to pay the lease in year 0. Okay, that's the payment, 35,000. So every year we're going to pay 35,000. But remember, this is a 4-year lease, so 35,000. We end in year 3. Okay, and then once we do that, we then have to ask ourselves if we have got any other tax savings. All right, and obviously we are going to get those savings. Okay, in most jurisdictions, lease payments are considered to be expenses of capital nature. All right, and they attract. Okay, they attract. I mean, not expenses of capital nature, but they are considered as they are tax deductible. All right, they are tax deductible, which means when you pay those, when you make, payment, or when you pay those costs, you can claim tax on them. Okay, you can claim tax on them. So they are tax deductible. All right. So how much tax are you going to save if you get the mess of the taxman? So every year we are going to save 35,000 multiplied by 30%, which is equal to 10,500. So we're going to have some tax savings of 10,500. But this is in line with the way at which tax is going to be paid. All right. So it is going to be in line with the years in which the tax is going to be paid. All right. Okay. Now this is where I want you to bear with me. All right. We have determined that there is a tax saving. There is a tax saving of 10,500 every year on lease. But when are we going to enjoy the saving? All right. How are we going to apportion or to allocate it amongst these years? All right. So we're going to enjoy this in year 2. But the question will be, how did we determine that we are going to first enjoy the saving in year 2? The issue is the decision to buy or to lease happened at the end of year 0. Okay, happened at the end of year 0 from the question. All right. If the machine is bought, it will be bought on the last day of the current financial year. All right. Presumably, this is the period when we enter into this lease or buy decision-making process. All right. So, yes, we paid the lease payments in advance. Okay, at the start of the year of each year. All right. Now, it was towards the end of year 0. All right, and we first used the lease in year 1. Okay, and the tax is paid at the end of each year. payable 1 year after the end of the financial year. All right. So the financial year was year 1. All right. The financial year was year 1. All right. So the tax is paid at the end of the financial, payable 1 year after the end of the financial year. So 1 year after year 1 is obviously year 2. All right. 1 year after year 1 is obviously year 2. So this is why we have put our first tax saving in year 2. All right. Because even if the lease was paid, okay, at the start of year 1 or at the end of year 0, that is at the start of year 1, we are not going to enjoy the tax saving in year 1 because tax is paid 1 year after the financial year. So 1 year after year 1, that is, we are going to enjoy the tax saving in year 2. Then the following will be in year 3, then year 4, then year 5. That's it. Let's move on. We can just add up and get our net cash flows. Net cash flow. 35,000. 35,000. Okay. 35,000 negative. And here that's negative 35,000 plus 10,500. We get our positive 24,500. 24,500. Okay, they are all negative. And then 10,500 is positive. Okay. Then we have to discount at the discount factor at 7%. All right. Discount factor at 7%. One, and here that's 1 over 1.07 to the power 1. That's 0.935. 1 over 1.07 to the power 2. 0.873. 1 over 1.07 to the power 3. That's 0.816. Then 1 over 1.07 to the power 4. That's 0.763. Then 1 over 1.07 to the power 5. And we get our PV. Okay. Then 24,500. Okay. Okay, that's 19,992. All right, and then 8,071. Then 7,486. Obviously, the NPV would be equal to 93,608 negative. Now, we need to compare which one has got the lowest NPV, because remember, these are costs. We want to go for that option that gives us the lower NPV, because that would maximize our wealth as the cost would be lower. Okay, the lower NPV in this case reflects that or signifies that the option is going to be a low cost option. All right, so comparing the two, the lease is actually giving us an NPV of negative 93,608, whereas the buying option is giving us the NPV of negative 69,961. Okay, so you can see that the lower cost is actually given by the buying decision. The buying option. All right, so we better buy the equipment than to lease it, because the ultimate cost of buying is only 69,961 versus the ultimate cost of leasing, which is 93,608. So we are better off if we buy the equipment. I hope we are together in this regard. Thank you.